Despite auto ancillary companies clocking strong revenues in the April-June quarter of FY23, margins were under pressure due to higher commodity costs and logistics snarls. However, with prices of key raw materials used in automobile manufacturing cooling off amid economic slowdown concerns, analysts expect related companies to see some relief over the next couple of months.
We remain bullish on auto and auto ancillary stocks because of two main reasons. The first one is easing of semiconductor shortages, wherein during the pandemic, a lot of semiconductors were used by computer manufacturers or laptop manufacturers. A part of that production is getting shifted to auto, and thereby the semiconductor availability for auto companies is increasing, which is leading to higher production for auto companies, and which will in turn lead to higher production for auto ancillaries. The second reason why we bullish on auto ancillaries is the falling commodity prices, which earlier was leading to margin compression. Now with falling commodity prices, that pressure on margin should ease, and there should be some gross margin expansion. Both these things, including lower raw material costs as well as higher utilization levels, should lead to higher EBITDA margins for auto ancillary companies, which thus is positive for the entire space.
New launches and demand uptick post-COVID-19 too have sparked hopes for a revival in the auto ancillary sector. According to reports, around 10 to 15 new passenger vehicle launches are lined up this year. Separately, the government's renewed push towards road safety may benefit auto ancillary companies involved in manufacturing of safety equipment.
Two things. One is semiconductor chip issue getting resolved, logistics side issues getting resolved, and if I'm not mistaken, I was reading one report, in the next 4 or 5 months, you are going to have at least 16 or 17 launches from across categories. Demand for ancillary, will definitely go up, and the Honorable Minister, Mr. Nitin Gadkari, has also mentioned about safety features in the vehicle to be improved and taken to the next level. So I think auto ancillaries companies which are basically, involved with manufacturing all those kind of safety equipments and OEMs will be one of the top priorities in terms of focus. And not only from the new order market, but replacement market is also a huge market for auto ancillary companies, wherein a lot of people would want to go and buy or replace, whatever needs to be replaced in their vehicle in form of original equipment instead of buying anything from the local market. So the raw material input cost is also likely to go down, wherein you will see some amount of margin improvement in terms of profitability.
That said, higher inventory costs may act as a spoilsport in the near term. Despite minor relief in margins due to cool-off in commodity prices, we expect margins to remain subdued in the July to September quarter of the current fiscal year due to high inventory costs. We expect profitability to be visible from Q4 FY23 onwards. On the bourses, shares of auto ancillary companies like Automotive Axles, Bosch, GNA Axles, Lumax Industries and Varroc Engineering have surged up 36% so far this year. In comparison, the S&P BSE Sensex and Nifty 50 have gained over 1% during the same period. As regards today, investors will track the European Central Bank's interest rate stance. Besides, rupee movement, crude oil prices and FII flows will continue to guide markets on Thursday.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.